everyone, I'm Aakriti and today I'll guide you through the different stages of fundraising from pre-seed to Series D and beyond. I'll cover the types of investors involved, how the funds are used, key rights and the principles of valuation. The journey starts at the pre-seed stage where the company is still refining its idea and product. At this point, funding comes primarily from friends and family or incubators. The funding amount is usually south of $250,000 and the money is typically used for product development and market research. It is difficult to determine the fair valuation of the startup at this stage as the business has not commenced yet. Thus, the valuation is kept low or often is not decided at this stage and is kept open to be determined on the basis of the valuation of a future funding round. In such a case, the investors are issued convertible instruments such as convertible preference shares, which convert at a discount to the valuation of the company in the next qualified price round of funding. The risk is very high for investors investing so early, but the potential for growth is appealing. Since it's a very early stage, there would not be too much discussion on special rights to the pre-seed investors. However, in most cases, they are offered the right to participate in future funding rounds of the company. As the company gains traction and the business achieves a product market fit, it moves to the seed stage, usually funded by angel investors. Angel investors are typically HNIs or family offices who invest their own money in early stage companies. The investment, usually between $250,000 to $1 million, is used to further develop the product, build the team, acquire customers, and start generating revenue. The valuation increases slightly but remains relatively low as the company has still not showcased sustainable revenue generation. The seed stage investors are typically issued compulsorily convertible preference shares that have a preference over other shareholders on the proceeds of liquidation of the company. Angel investors typically also seek information rights to monitor progress and would want the option to invest in future funding rounds. Next, the company enters the Series A stage, funded by venture capital funds. These funds pool money from various investors known as limited partners to fund startup. At this stage, the investment typically ranges from $1 million to $10 million and is used to scale the product, undertake marketing expenses, expand the team, and grow sales. The valuation is higher due to proven market demand, but risk remains as scaling is still required. Apart from the special rights that we already discussed, Series A investors generally also seek board seats or observer rights to have visibility of the board's decisions, veto rights to influence major decisions, lock-in of the founder's shares, and a right to seek exit within a specified time frame. As the company matures, it progresses to Series B round and other later rounds such as Series C, Series D, etc., typically involving larger institutional investors such as private equity firms and larger venture funds. The investment typically ranges from $10 million and upwards, and the funds are used to further expansion, capital expenditure, entering new markets, or making acquisitions. By this point, the company has demonstrated it can scale, and the valuation typically gets progressively higher, reflecting its market presence and influence. Investors in these rounds often negotiate liquidation preference over the previous investors, stronger veto rights on major decisions of the management, and robust exit rights. These later rounds also provide an avenue for earlier investors to exit at this stage with substantial returns through secondary transactions. Throughout these stages, a key document is the term sheet, which outlines the investment terms, including the amount being raised, the valuation, and the rights granted to the investors. Once the term sheet is agreed upon, the deal is formalized through a share subscription agreement and the shareholders agreement. The subscription agreement governs the issuance of shares, while the shareholder agreement outlines shareholder rights, obligations, including voting rights, board representation, and exit rights. In conclusion, as the company progresses through each funding stage, the investors become more sophisticated and the terms become more complex. Understanding the types of rights investors seek and how the risk and evaluation evolves at each stage is crucial for both founders and investors to be aligned to establish a beneficial partnership aimed at their mutual success.